We have just completed the annual update of our 5-year capital market assumptions, further lowering our outlook for growth and interest rates. So what are the implications for investors? Let me start by reviewing some of our key themes, which help drive our economic and financial market outlook. The first theme is slow growth angst, where the continued lackluster demand environment will further impede growth as companies remain hesitant to invest. The second theme is market cycles in a cycleless economy. We think that risk markets will be more volatile due to shifting sentiment than the underlying economy and interest rates. The final theme I'd like to highlight is called populist roulette, where concern over populist politics globally add further uncertainty to the slow growth environment. Slower growth and relatively high valuations have moderated our expectations for risk assets. We expect developed market equity returns of 5.4% annually, bookended by emerging market returns of 7.3% at the top end, and U.S. returns of just under 5% at the low end. Slow growth hurts the corporate revenue outlook, but low inflation and interest rates support margins and ease valuation headwinds. We expect real assets to perform relatively well, led by a forecasted return of nearly 7% for natural resources. This return expectation is bolstered by the massive underperformance of natural resources over the last 5 years. Our forecasts for both private equity and hedge funds have been reduced due to lower expected stock market returns and somewhat due to increased competition. However, we continue to think private equity will deliver a solid premium of 2% to public equities, while well-selected hedge funds can provide an attractive risk-adjusted return. With our moderate outlook for growth and inflation, we believe interest rates will stay low and expect positive returns broadly across fixed income. We expect cash returns to be low to negative as monetary accommodation is extended. We expect the U.S. 10-year Treasury to sport a yield of just 1.5% in 5 years' time, capped by the German 10-year yield of just 0.5% and the Japanese 10-year at 0%. While we expect to see some modest deterioration in corporate credit quality, continued low rates and strong investor demand should lead to further spread tightening for investment-grade bonds. We do expect an uptick in high-yield bond defaults, but project a 5% total return, which is attractive compared to the outlook for the equity markets. So what does all this mean for investors? While the growth outlook continues to disappoint, we expect the resulting low interest rate environment to support risk asset pricing. Our forecasted return for a mid-level risk portfolio is 5% this year, down from 5.4% last year. While the expected return is lower, we still expect a diversified portfolio to handily outpace inflation, which warrants staying fully invested. As always, the most important aspect of our portfolio management is the proper alignment of your goals with your investment assets, ensuring you have the proper liquidity to ride out the inevitable volatility we will see over the next 5 years.